market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a consequential day for global politics, with world leaders on the move against the backdrop of the Ukrainian war. A Bloomberg scoop this morning, the U.S. urging Europeans to oppose EU plans to use frozen Russian assets to back a massive loan to Kyiv. Now, it comes with the Russian President Vladimir Putin in New Delhi as he looks to deepen economic ties with India despite pressure from the White House. Meanwhile, the French President Emmanuel Macron is in China meeting President Xi Jinping, with panda diplomacy back on display. Now, here in Europe, the German Chancellor faces a crunch vote that could lead to the demise of his ruling coalition only 7 months into a 4-year term. So joining us now, Julien Lafargue, Chief Market Strategist at Barclays Private Bank. We're also joined by Tina Fordham, founder of Fordham Global Foresight. So thank you both for joining us. I know you're looking at eco and a lot of the data. Tina, you're looking at diplomacy, and it feels like everything's happening at once in these 2 days. Would the U.S. President, actually, Donald Trump, first of all, look at Vladimir Putin and Modi in India today?
Well, he was a little bit sad, wasn't he, when they all met up, Xi, Putin, and Modi at the Shanghai Cooperation Organization meeting. He seemed to feel a bit left out. But I actually think the Modi-Putin meeting is important, especially for Modi, who is working hard to show that he won't back down in the face of U.S. threats. But I think the real event is what's happening in Brussels today with Merz and Bart de Wever.
And so what are you expecting there?
I don't expect there to be a breakthrough, but it's impossible to underestimate how important this issue of the use of frozen Russian assets is to the outcome of European security, and then coming on the back of this bombshell new U.S. national security document that was published last night.
Julien, give me a sense of what this means for investors. I know investors have, I guess, seen points of stress, and that's translated into oil because of all the geopolitics. But actually, they're now largely, looking through a lot of the tariffs concerns. Could that come back at the forefront when you see big leaders across the world trying to sign deals?
Yeah, clearly, I don't think we're done with tariffs. Of course, we're waiting for the Supreme Court to express its opinion around the reciprocal tariff. It looks like, we're moving into a much more multipolar world. And so you're going to see alliances form in different corners of the world. And the result is you're going to have much more volatility and headline volatility around geopolitics. So this is something that we expect to continue in 2026, but way beyond as well.
Okay, let's also talk a little bit more about, of course, the visit of Vladimir Putin over in India. Our senior reporter, Dan Strumpf, is in New Delhi. So, Dan, just bring us up to date with the developments there.
Hi, good morning. Yeah, that's right. Vladimir Putin arrived here in New Delhi just yesterday. Today, we saw both Putin and Modi in their first bilateral meeting taking place this afternoon. We don't know exactly the outcome of that meeting just yet. We're expecting a press conference to bring some announcements there, which could happen actually just any minute now. But we do know that economic and trade talks are really at the center of this visit. Both sides have signaled that they are very eager to deepen their trade and economic partnerships, as well as partnerships around areas like migration. Is kind of a real way to sort of show that this partnership between India and Russia is alive and well in the face of pressure from the U.S., which both countries are facing quite heavily right now.
But so, Dan, I mean, is this on oil? Because India still needs quite a lot of Russian oil. And is there a danger that actually Washington reacts quite badly by imposing extra sanctions or try to break the two apart?
So Russia has been a growing supplier of oil to India this year. Now, that's been a real source of strain between the U.S. and India. India has been working to reduce its reliance on Russian oil, and that has come down in recent months. Now, what we haven't seen is the U.S. respond with an easing of its really quite debilitating 50% tariffs on India in response. And so what's happening is that India and Russia are looking to expand their partnership beyond these sort of traditional areas around energy and around defense to include a much wider range of trade in other goods. And for India, that really helps to kind of offset the impact of those tariffs from the U.S.
Dan, thank you so much. Our senior reporter there in India, Dan Strumpf. Julien, again, does this show up in inflation data at the margins if we're going to see more geopolitical allies and blocs coming together?
Well, we haven't seen it so far. If you look at what oil price has done year to date, clearly it doesn't feel like we are in this world where geopolitical tensions are quite significant. It will obviously create some tension, especially if we're seeing more tariff being implemented. But I think at this point it's very difficult to expect more tariff to be implemented as we're waiting for this decision by the Supreme Court.
And Tina, I mean, this also comes, I mean, there are two other things, right, going on at the same time. Emmanuel Macron is in China, so I want to get your thoughts on what that means for Europe trying to, have a better relationship with China, maybe to counter India and Russia. And the other thing is also the German chancellor is really in a sticky spot. So how much does that weaken Europe?
Europe is caught between coercive powers. We always knew that 2025 was going to be a big wake-up call. But the really astonishing turn of events, again, mentioning this new U.S. national security strategy, is how the United States, Russia, and China appear to be treating Europe as a diminishing concern, despite being the world's third largest trading and economic bloc. And the way that feeds into support for leaders in elections and everything else really matters. What Macron is doing is hedge America. And similarly, Putin and Modi meeting today are also looking to shore up alliances. More volatility, has been mentioned, but what we're talking about is the remaking of the international global power structure, which won't settle into a new pattern. This is going to be messy for an extended period of time.
The other thing, Tina, that I want to ask you about is that you're also writing extensively on this U.S. public discontent with affordability in the U.S. Does that really goes against the Trump administration? Are they being blamed for it?
So the affordability crisis is really, top of the list for U.S. public concerns as we head into this midterm year. We had the Tennessee special election take place, and although the Republican candidate won by a very comfortable margin, that district was won by President Trump by 22 points, and it dropped quite a bit. So there's a lot of panic in Republican corners about affordability. What matters is what the response is. At this point, the Republican National Committee response seems to be double down on MAGA. And you've seen President Trump say that affordability is a Democrat hoax and other kinds of dismissive terms. This reminds me of what the Biden administration was saying when Americans were upset about inflation, despite the fact that his administration achieved other goals. And it turns out inflation is really the most toxic factor in politics in developed markets.
And Julien, so what does that mean? It seems that uncertainty is probably the only uncertainty for 2026. So how do you build on that, given what Tina was saying for the markets?
I think, we've just released our Outlook 2026, and frankly, it was one of the toughest ones to write because there are so many wild cards that having a clear view as to how 26 will play out is very difficult. I think you want to do two things. You want to focus on the really strong underlying trends and build on that. And the second thing you want to do is you really want to be a bit more agile and tactical this year because the narrative is going to keep shifting, whether it's tariff, whether it's the Fed, whether it's geopolitics, and there's no way to predict how this is going to play out. So we have to approach every quarter with a different pair of eyes and see how we're going to position for the next 3 months, and then we do that again. I think that's the only way.
So, Julien, do you actually see opportunities beyond the U.S. and beyond AI?
Yeah, I think definitely you want to be able to diversify away from the U.S., away from AI. One particular part of the market that we think is extremely attractive at the moment is everything that is linked to quality. Quality as a style has underperformed massively. There is no reason why you shouldn't own quality if you're investing for the medium to long term. And we see this is where you want to put your focus on, whether it's on the fixed income side or the equity side, quality is probably the style that we prefer at the moment.
And Tina, what's your wild card for 2026? Does geopolitics really also work through AI and this massive fight between the U.S. and China to be number one in the game?
Well, I mean, I would say this, Francine, but geopolitics does cut across all of these topics because, as you've heard me say so many times over the years, geopolitics is about power and power projection. It's not a negative externality, as economists like to talk about it. So whether it's AI, critical minerals, energy security, or these frozen Russian assets and how they are disposed of, it all comes down to this great power competition and the other countries, middle powers like India, Saudi Arabia, Brazil, for example, really fighting to have their weight and their agency register in the global system. It's tough out there.
Yeah. It certainly is. Tina and Julien, thanks so much for joining us. Julien Lafargue, Chief Market Strategist at Barclays Private Bank, and Tina Fordham, founder of Fordham Global Foresight. Coming up next, we'll be speaking with Brian Moynihan, the Chief Executive of Bank of America. We also have two other interviews you don't want to miss. The U.S. Ambassador to the EU and, of course, a new Lady Mayor of the City of London. Also, a little bit later on in the program. This is Bloomberg. The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, we've had a data blackout after the longest U.S. government shutdown in history. Investors, of course, closely watching the release of key inflation data a little bit later ahead of a widely expected rate cut by the Fed next week. Let's discuss what it means for the U.S. economy and the banking sector on Wall Street with Brian Moynihan, Chief Executive of Bank of America, which also just laid out new financial targets at its Investor Day last month, its first in almost 15 years. So, Brian, thank you so much for joining us. Congratulations on the Investor Day.
Oh, thank you.
I'll ask you about that in just a second. But first of all, how's the U.S. economy doing, actually? How's the U.S. consumer holding up?
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money are 70 million consumers who's pushed about $4.5 trillion plus in the economy every year. They pushed in about, for that month, about 4.5%. And so it was good, and around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good, and it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort the aggregate economic impact of the consumer, our 70 million consumers spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is, with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to compared to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
Would a Fed cut help?
A Fed cut helps, and our team believes the Fed will cut next week. They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
And sticky.
It's sticky, although right when they started raising rates, people told me it takes 5 years to actually squeeze out inflation, and people just aren't patient, and so it takes a while. So it's been coming down, and it's it's sticky. Is that it's not making the incremental progress a little different? But I think the belief is because the labor market's softer, they'll lower rates. That's how our team got there. But we get into the hand-to-hand combat of next month and next week, and the question really is longer term. Our team thinks the Fed gets down to about a 3% Fed funds rate. The 10-year rate sits in 4.25%, 4.5%, and that's a more normal rate structure for the United States. And I think that's not a bad thing. If you have a little higher inflation, a little faster growth, and a normal rate structure, then I think the the incentives created by very low rates and stuff are out of the system, and I think people can then act on economic incentives.
And so what does that mean? That animal spirits are back in terms of also, IPOs and M&A, or does it take a while to settle? The market was also a little bit of a tissel because of the possible new Fed chair being Kevin Hassett.
Yeah, I think you've got to, I walked the trading floor this morning, you've got to sort out people who worry about 5 basis points on the 10-year versus people who worry about the next 50 years in the United States and a strategic view of the world. But if you look at companies, the activity kicked up after the new administration came in because there are a couple things. One was that you could get deals through the system, get them done, especially in the United States, and that's important. So in our industry, which we are not allowed to make any acquisitions deposits by the law, it's been on books for 30 years. But in our industry, as an investment banking firm, our advice is you can get deals done, and you're seeing the time frame to approve a deal drop by half. And that's important because the idea of a deal being open for a year and a half, that's tough on the companies. And so that's good news. Then the second thing is settling out the major policies that you guys talk about every day on trade and immigration and tax. Those are settling in so people can see that. There's still work to do. But I think that means that companies can look and discount cash flows and make decisions. And then even a rate structure that's higher, as long as it's consistent, they can plan into it.
Brian, you know Kevin Hassett, and you've known him for quite some time.
Yeah.
What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's a lot of commentary about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with, Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say, some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think, again, they're ready to do deals? Well,
generally there's things that you look at, you say, I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much I can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clearer that there's sort of 10 to 15% increase is generally across the board result. That's helped businesses understand it better. And so I think that's been worked into their plans. And that's why you're seeing the relief come off from Liberation Day, where people were very confused, to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique. But I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes. But generally, they're more worried about the ability to address markets and drive. And I think one of the things administration's worked on that gets lost in the percentages and count is the non-tariff barriers, and those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States but around the world, because to get access to markets without having to change product is a big deal.
What's your take on the UK? So we had a budget. It didn't 100% go well for all companies, but I think there was a sigh of relief that at least we know what there is. JP Morgan's building massive building in London. Are you committed to London?
We have 6,000 teammates. We just announced we're adding another 1,000 teammates in Belfast that will specialize in certain areas that we know we can get the talent there and help grow that economy. And so we're in London. We believe in London. We've been here for a long time. It's just part of who we are. I think the UK, London in particular, is a great place for multinational, international operations. So Bernie Menz that runs international is here. And I walked the trading floor today, and the Asian traders and the Middle Eastern traders and the EU traders, and everybody was up and working. And so I think it's a great thing. The key is for the policies to make sure that you distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. Because if you're a good place with the rule of law and the great city that London and the great country that UK is, there's plenty of upside in a world where there's not that many places where people can get young kids to go to work. We're just about young kids. Remember, we bring 2,000 kids in from school every year. They've got to want to work in the cities, and so New York and here and other places have a leg up if they just handle it right.
So what do you tell the Prime Minister?
I tell them to make sure the regulation's fair. And protect it, but also materiality is the hardest thing for governments to understand. We have 6,000 teammates here. It's an incredibly important operation. It's 20% of our revenues. Our international business has grown nicely, but it's 20% of our revenue and things like that. We have hundreds of billions of dollars of capital to make sure things are all right. So if you make it hard to operate, that's when people start to make decisions, or make it uncomfortable for taxation for their workers. That's where they make decisions. Or expats coming in, that's where they make decisions. So I think our advice is be the best place for a non-UK based company to operate, and you'll get companies coming here. And it won't be that people leave, it's just where the next 500,000 people are going to go.
Brian, talk to me about your Investor Day. I mean, this was the first in 15 years. You set up some really ambitious targets. Are you happy with the way it went and the way it was received?
Yeah, it was great. It was a chance to show the hugely competitive advantage we have as a franchise, the moats we have on it, what all the technology spending done. We talked about what we do in AI that people are asking a lot about. We showed that it's actually not theoretical. Bank of America, the Erica, will interface with 2 million customers today at Bank of America, which is an AI bot. So we gave that view, and we showed in each of the businesses how the competitive position they have. Their top businesses, number 1, number 2, number 3. They're growing organically, have been. And then the returns come back as the NII and the pricing on the fixed assets. So we talked about our net interest income growing at 5 to 7%. The industry's growing at 2 to 3%. That's really coming from the balance sheet, continue to reprice while we generate good organic growth. And it was good. And so we thought the returns would reach 16% return on tangible common equity, moving up to 18, and last quarter we had 15, and we grew EPS, I think 25-30%. It was a good quarter, and the team does a great job for us.
You know, I need to talk soccer or football.
Yeah.
I may get my nationality pulled away if I call it soccer, but are you now a football guy? I mean, you're sponsoring FIFA. The World Cup is coming to America.
Well, I have to say, as an American, I am a football person. It's just not the same football. Look. The draws tonight, we're very excited. We are a sponsor. We are the major financial sponsor for FIFA, working with Johnny and the team for the last 3-4 years now on this. Our team has got a set of programs. Just today we announced that if you apply and get a credit card, you get a chance to go into lottery to buy tickets and things like that. And our clients are excited. The cities are hosting are excited. We're working in the cities. We're working with other colleagues, other companies to put fields in these cities, at FIFA and Visa and others. These are all important things, because what we're trying to do is bring soccer into places and have it, when the World Cup goes away, which will be a wonderful event, to have the FIFA World Cup continue through these fields.
Brian, the most difficult question, who do you support if not USA?
Well, we have to support the USA.
I know, but your second team, do you have a second team?
I've got too many colleagues around the world that have come after me for that.
You're going to get the calls, the hate calls. Brian, thank you so much for joining us. Brian Moynihan, Chairman and Chief Executive of Bank of America. Coming up, our exclusive conversation with Andrew Puzder, the U.S. Ambassador to the EU. We discuss the Russian invasion of Ukraine and, of course, competition and regulation concerns in Brussels. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German Chancellor braces for a key pension vote in Parliament that could signal the end of his coalition if he loses. So let's return to our top story this morning. And Bloomberg understands that the U.S. lobbied several countries in the European Union in an effort to block EU plans to use frozen Russian assets to back a massive loan to Ukraine. Now, U.S. officials argued to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. Well, joining us now for an exclusive interview is Andrew Puzder, the U.S. ambassador to the EU. Ambassador, thank you so much for joining us. So because of this Bloomberg scoop, can you just run us through the logic or exactly what the U.S. wants?
With respect to the Russian assets loan? Is that what you're asking?
Yes, yes, Ambassador.
Can you hear me?
We understand that some U.S. officials have lobbied several countries in the EU to block EU plans to use some of these Russian frozen assets. What's behind that?
The first I heard about that was when I walked into the studio this morning. I haven't been briefed on it, and I have no idea.
Okay, Ambassador, do you think, is there a concern? I mean, have you heard about some of your officials briefing, or have you had calls from EU trying to understand what the official U.S. position is? What do you think the official U.S. position is on this?
Well, I don't want to speculate on what the U.S. position is, and no, I haven't had calls from anybody in the EU or the administration on this issue. Again, the first I heard about this was when I walked into the Bloomberg studio this morning, so I have no idea if there's been lobbying, or if there hasn't been lobbying, or who would be doing it.
Ambassador, talk to me then a little bit about regulation. You've spoken on regulation about the need for the EU to pull back its regulatory burden. What specifically are you referring to?
Well, I'd say the two principal areas would be what's called the Corporate Sustainability Due Diligence Directive, the Corporate Sustainability Reporting Directive, and then the Digital Marketing Act and the Digital Services Act. I think those are really contrary to the EU's best economic interests. One of them makes it very difficult for the EU to get inexpensive energy, which it desperately needs. And the other makes it difficult for it to get the cloud services and the sophisticated AI software that they need and the investment they need here on the European continent to participate in the AI economy. So as the U.S. ambassador here, of course, I'm very interested in advancing President Trump's efforts to make America safer, stronger, and more prosperous. But that doesn't mean we have to leave Europe aside. We want to make America great again, but we'd like Europe to be right there with us, particularly in this AI war. And these regulations make it very difficult for Europe to participate in the AI economy.
Ambassador, yesterday, I mean, we heard a post that was quite aggressive on X from the Vice President J.D. Vance on the EU Commission's plans to fine X for not engaging in censorship. Again, I mean, we understand that the EU, is talking about breaching transparency requirements. What's your take on this? Is it censoring, or is there a way forward?
Well, I will say it's somewhat of a coincidence that every company that seems to get fined with respect to these digital services or Digital Marketing Act violations is an American company, and so I have not. The X fine, the news just came out last night. I haven't had a chance to look through and see what the basis of that fine is, but I know the Vice President is very concerned about limits that are unfair against American companies, enforcement of legislation that's really contrary to the spirit of the free trade agreement, where we're trying to eliminate non-tariff trade barriers when you're singling out American companies for regulatory action. That really is not within the spirit of that agreement. And he's also very concerned with aspects of free speech. The First Amendment is a very important right in the United States, the right to free speech, the right to free expression, and the Vice President is very concerned about violations of those rights.
Yeah, I mean, I think the Commission is talking about, accessing data, misleading users with potential fines. They have not that decided yet. Ambassador, do you think it's targeting U.S. companies, or is it just targeting companies that happen to be American?
Well, they happen to be American because the legislation was drafted in a way that it would basically cover only American companies. I think there's 8 companies that are covered by this legislation. I think 7 of them are American companies. And the only substantial, meaningful fines that have been imposed so far have been against American companies. So at some point, if you're an American company, you've got to sit back and say, look, am I being targeted here? Or is this an effort to try and advantage European competitors over U.S. companies? And if that's the case, it's something that the United States needs to respond to. And I believe the Vice President has been very active in that respect.
Ambassador, let's also look at the Corporate Sustainability Due Diligence Directive. Where do you see this going?
Well, I don't know where it goes. There's two problems with it. One, the big problem is that Europe needs energy. If Europe's going to run an industrial economy, it needs inexpensive energy or reasonably priced energy, and it needs abundant energy. And if it's going to participate in an AI economy, it needs even more energy because you have these terrific energy demands that come with these large data centers. If you're going to be a participant in the AI economy, and both President von der Leyen and Professor Draghi have been very adamant that Europe needs to participate in the AI economy, and the U.S. would like Europe to participate. But when you pass regulations that impose net zero mandates on oil companies, and when those mandates reach not only into the supply chain, the direct supply chains, but the indirect supply chains of companies that really have no nexus to Europe, that don't do business here, don't want to do business here, but are somehow in a supply chain of a large multinational oil company or fossil fuel company. When you make those kinds of restrictions, you make it very difficult for these producers to supply Europe with the energy that it needs. So I think it's a regulation that just is not in Europe's best interest and is not in the best interest of making Europe a prosperous and vibrant economy.
Ambassador, what about steel and aluminium? I know EU exporters, for example, are being hit by 50% tariffs, with 400 items now being subject to this tariff rate. Is there any progress or any sign of breakthrough in this?
Well, the idea with the iron aluminum tariffs, both the United States and Europe now have 50% tariffs. Originally, the United States was concerned that China is dumping steel and aluminum on the market, and we wanted to make sure that these derivative products, the 407 that you mentioned, that they wouldn't contain Chinese steel or aluminum, which could get dumped in America. Now, Europe is saying that's not going to happen. That's not what they're going to do. Our Secretary of Commerce and our trade representative were here in Europe last week and made it clear if we can make some progress on these lawsuits, these regulatory actions against America's tech companies, if we can make some progress there, we can make progress on these derivative issues too. So I think both sides are talking, both sides are negotiating, and I think eventually this will get resolved. I just don't think it's been resolved yet.
Ambassador, I just wanted to go back to Ukraine, because today is a very, very crucial day for the EU's plan to tap these immobilized Russian assets to help Ukraine. What do you understand the U.S. position to be today?
Look, this is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. I don't want to comment on this area and have some impact on negotiations I'm not involved in. And so it's really difficult for me to comment on it.
I understand. We're just, if the U.S. were to call European countries to try and tell them, like, look, this is not the right way, do you think there's a danger that the U.S. is trying to force Ukrainians to capitulate to Russia? Is this how you would see it?
Well, I'm not going to comment on a hypothetical. I'm certainly not going to give my opinion on an issue where I could actually have an impact on negotiations that I'm not involved in. That's just not something I would do.
Ambassador, thank you so much for your time, and thank you for joining us. Andrew Puzder, there, the U.S. ambassador to the EU. Now, turning to defense, and Bloomberg's chief Europe correspondent, Oliver Crook, sat down with the chief executive of Rheinmetall earlier this morning to discuss the challenges facing the sector.
I wish that peace is coming in Ukraine, because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard to that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that, because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunition, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. But if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
The Rheinmetall chief executive speaking with our chief Europe correspondent, Oliver Crook. Now, coming up, we'll be joined by the new Lady Mayor of the City of London, find out how Susan Langley plans to attract investment to the capital next. This is Bloomberg. Welcome back, everyone. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and the HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Baigorri. Manuel, how significant would this be?
Francine, it is very significant. Indeed, it's a transformative deal in the entertainment industry, not just in the US, but globally, right? Netflix has become such a major powerhouse, and Warner Brothers is such an iconic brand. So it sounds like they're getting closer to the potential sale of the film and TV assets, as well as HBO Max. So that would definitely create a formidable, company in that space, and it will also send some shockwaves for other competitors. Comcast, Paramount, among others, were also eyeing these assets. So definitely a big transaction that seems to be just days away from a potential announcement.
Manuel, thanks so much. Manuel Baigorri there with the very latest on Warner Brothers Discovery. Now, the City of London remains a global hub for talent and wealth, but has faced challenges over recent years. Well, someone tasked with improving the outlook is the new Lady Mayor of the City of London, Susan Langley, who joins us now. So, Lady Mayor, first of all, congratulations on the appointment. You come adorned with...
I come adorned with, yes, an awfully large badge. Yes, I do.
I mean, an awfully large badge because you have, an enormous job, actually. What do you hope to achieve over the next year in trying to promote London's financial services to the world?
Well, the role of the Lady Mayor is the ambassador for financial and professional services in the City of London and for the UK. And I like to think of the Mansion House as the embassy for FPS. So really, my role is to promote the city, 100 days overseas, travelling as global ambassador, but for the city, we have to focus on matching capital with opportunity, and that's both financial and also human talent.
Yeah, so what will you focus on? How do you attract more talent to the UK? Finally, we had the budget. It feels like it was a long time coming, or certainly there were quite a lot of leaks in the run-up. What can be improved on?
Well, you're absolutely right. There were a lot of leaks in the run-up, and as you know, uncertainty is not good for business. It stops business making decisions. So now we have certainty, we can actually move forward. One of the things for me, well, there were two things for me, really. First is promotion. I mean, I actually think in the UK we are really good at saying what we're not good at, and we are really not good at saying what we are good at, and we're brilliant at things. I think, we're the #1 in the whole of Europe for fintech unicorns. My sector, insurance, we're the global risk centre of the world. And one of the things we need to do is actually be slightly less British and actually promote the city and the ecosystem around it. And then the second thing with talents, I mean, I'm an East Ender, so this is one of my passions. And you might have heard a phrase has got coined, which is unsquare the square mile. And by that, I actually mean, I think the word square for the city kind of implies something that's closed off, fenced, old-fashioned, and it's neither of those things. It's open to all talent, look at me, and it's not old-fashioned. We build on our history, but we're innovative and forward-looking. We're a fantastic city.
What I hear a lot is the lack of risk-taking, and this could be either pension funds or just the lack of investing, for example, in private companies from, pensions. And I know that's slowly changing. But if you had a magic wand to do something differently for the City of London, to, I guess, increase the capital pool, what would that be?
I'd simplify regulation. So I think the regulators have taken some great steps with the secondary competitiveness objective. But the trouble with incremental change, especially in a fast-paced world, is it's not fast enough. And if we look at some of our competitors, they have some really simple, cutting-edge regulation in certain areas. So personally, if I had that magic wand, I wouldn't incrementally change and peel back the layers, because that's really hard to do. I'd look at certain centres, I'd copy best of breed, and I'd reimagine, not amend.
This is what, for the banks or financial services in general? Is it ring fencing? Is it, something to also keep up with the US?
Yeah. It's financial services in general, OK? So in some areas we're brilliant, OK? Our regulation is great. And also we have a very stable business environment, and regulation gives us that. But if you want to encourage risk-taking, you are going to have to roll back regulation to a degree. It's that balance between risk and progress.
I mean, there's been a lot of coverage about Lloyd's of London and its previous CEO in recent weeks. Does this industry have to change?
See, my experience is no, OK? I've had a fantastic career. I've come from, I call this an accidental career, from East End to chair. I think there's always more to do in this industry. Cases like that always get profile, but my experience is it's equal, it's fair. I've had a great career, I've had a lot of support through it, and if any women were thinking of coming into this industry, I really would encourage them. It's a great industry to be in.
Lady Mayor, can I ask you about what you think of, crypto? The crypto world is cozying up to Nigel Farage. Like, what does it mean for London as a financial centre?
I think it's one of the areas where we really need to focus on, because it's one of the areas that some of our competitors have as a real strength. So it's just something, I just think it's something for the city that we need to start working on. We need to get some regulations in and decide what our policy and our strategy actually is. Clarity is always good for business.
Is there, again, danger that actually the crypto world just is seen as cozying up to the more right-wing faction of politics?
See, I don't think business should be like that. Business should be apolitical. My role is apolitical. We work with the government of the day. We will support the government of the day. And for business, business is commercial. It just needs to do what's right for business.
Lady Mayor, thank you so much for joining us. Suzanne Langley there, Lady Mayor of the City of London. I know we'll speak to the Lady Mayor much more often, because we're just a stone's throw, but there's also so much that Lady Mayor wants to do. Now, key U.S. inflation data due out a little bit later today, pushing up expectations of a Fed rate cut. Ven Ram, Bloomberg MLife strategist, joins us now. So, Ven, what's the data likely to tell us today?
Morning, Francine. Always great to be talking to you. I think that, the expectations on the street is that, that we will get a milder core PCE reading. But the fact of the matter is that it's going to be, if it comes out as forecast, we'll get a number of 2.8%. Now, if you look at the average for this year, that is exactly where it lands, 2.8%. So, and we haven't had a sub 2% print in more than 4 years now. So there's been a lot of progress made on disinflation. We progressively got down from punitively high levels to three handle, and then we have come down to a below 3 handle. But the transition from 3 to 2 isn't quite happening, and that is going to be the big question for the Fed, which meets next week.
So, Treasuries fell after that jobless claims, report dropped to the lowest level since 2022. What's the broader implication of that, then?
Well, I mean, what we've been seeing is bits and pieces of erratic data where, we got the ADP report showing a contraction, and then we got the initial jobless claims today. So it looks like the economy is muddling through. And the Fed is kind of expecting average growth, GDP to grow 1.8%. That is smack in line with the trend growth forecast for the U.S. economy in the long run. So if the U.S. economy muddles through, the question is, what is the right level for, say, the 10-year yield? We have been doing 4% plus, and I think that strikes me as the right thing, because you've got core PCE, as we just discussed, around 2.8%, holding around 2.8%, and you've got nominal GDP growth of 1.8%. So that suggests that the 10-year yield should be above 4%, which is what we are doing at the moment.
Yeah. Ven, how much do you think, we also had Brian Moynihan of Bank of America. We talked a little bit about Kevin Hassett. He says, first of all, let's see who the president nominates. But what exactly is the market going to be focusing on away from data over the next couple of months?
I think that, they will be keen to find out, what kind of a consensus that Hassett will be able to drive within the FOMC. That is the big question, the immediate question for the markets over the next couple of months, because assuming that Hassett is nominated to be the Fed chair, I think that the question is, there's going to be a radical change to the FOMC committee come February. The composition is going to change. And what kind of a Fed 90-member committee that we will get, and whether Hassett will be able to drive a consensus thereof. And I think that, if you look at the dot plot of September, fully 5 members were already inclined to take rates below 3%. So I think that his job shouldn't be as difficult as the markets envisage. But, that is the big question for the markets going into the first 2 months of the year.
Ven, as always, thank you so much for all of your analysis. Our Bloomberg and Life strategist there, Ven Ram. Up next, Bloomberg Brief. Of course, there is quite a lot going on with the markets. We had a really good conversation with Brian Moynihan talking about the strength of the U.S. economy and, of course, the strength of the U.S. consumer, despite concerns about affordability across the board. Now, this is a picture overall for the S&P 500 futures, actually pushing higher with possibly a new record in sight. We also look at a measure of volatility dropping to the lowest since October. The dollar slipping. Treasuries pretty much steady with a rate cut next week largely priced in. And then there seems to be growing confidence that the U.S. economy remains resilient, in prompting rotation into stocks that I guess if you speak to investors or people on the ground, portfolio managers, that tends to benefit from domestic strength with investors gearing up for a year-end rally. Now, a couple of other things we're watching out for. Look, there's this rate cut next week, largely priced in the U.S., bets pointing to further easing into 2026. We have a couple of corporates we're watching out for example, Swiss Re here in Europe announcing its first share buyback in 5 years. Warner Brothers entering exclusive negotiations to sell its film and TV studios, HBO Max streaming service, to Netflix. Up next, it's Bloomberg Brief, and this is Bloomberg.